For most people, the stock market looks like a machine. You put money in, time passes, the line goes up. That belief didn't come from nowhere. For decades, especially after World War II, markets appeared to reward patience. Indexes rose, retirement accounts grew. Entire generations were taught a simple idea: buy good companies, hold them long enough, and wealth will follow. But that story is incomplete, because the stock market was never designed to make everyone rich. It was designed to move capital, from those who don't need it to those who do. Understanding that changes everything. In the real world, the stock market is not a savings account. It is a marketplace for risk, emotion, and expectations. Prices don't rise because companies are good. They rise because enough people believe future cash flows will be higher than previously expected. That difference matters. In school, finance is often presented as logic and math. In reality, markets are driven by human behavior: fear, greed, uncertainty, and crowd psychology. This is why markets often fall when the economy looks strong and rise when the news feels terrible. In the short term, markets react not to reality, but to surprises. Public markets exist to allow companies and governments to raise capital. When shares are first issued, money flows to the issuer. After that, most trading happens between investors. No new value is created when shares change hands. Only ownership changes. Yet every day, trillions of dollars move as people try to predict what others will do next. Professional investors don't trade against the market. They trade against other people. And not everyone arrives with the same information, tools, or time horizon. Large institutions think in probabilities. Retail investors think in stories. Institutions ask what is already priced in. Retail investors ask what could happen. This difference explains why markets often punish obvious ideas. When everyone agrees something is good news, the price has usually already adjusted. By the time certainty feels comfortable, the opportunity is often gone. The market does not reward being right. It rewards being early, or being patient when others cannot be. But patience alone is not enough, because time in the market only works if you can survive volatility. During major market drops, most losses don't come from bad investments. They come from forced decisions. People sell not because they want to, but because they have to. Job losses, margin calls, fear of deeper losses. This is where the market quietly transfers wealth, from those who need liquidity to those who already have it. Every major cycle creates the same two groups: those who are forced to react and those who are positioned to respond. The difference is liquidity. During downturns, large asset managers don't stop operating. They rebalance. They deploy capital according to long-term mandates. Retail investors experience the market personally. A falling portfolio isn't abstract. It's rent money. It's tuition. It's security disappearing. Losses feel urgent. Volatility feels permanent. Selling feels like relief. This is why most long-term market returns come from short, unpredictable periods, often when pessimism is highest. Missing those moments changes everything. But being present during them requires a margin of safety. Markets don't test your stock picks. They test your structure. Income stability, debt levels, emergency cash. Without these, even good investments fail at the worst possible time. Over time, this is why market participation becomes unequal. Those with excess capital can tolerate volatility. Those without it experience volatility as danger. The market does not move on what will happen. It moves on expectations, and expectations are fragile. Good news can crash prices. Bad news can spark rallies. Because markets are not moral systems, they are expectation machines. For today's investor, the most important question is not which stock will win. It is how much uncertainty you can survive without acting. How long your capital can stay invested without needing rescue. Whether you can hold positions when narratives collapse. The market does not punish ignorance. It punishes fragility. And it rewards those who build systems strong enough to endure discomfort. The stock market doesn't reward excitement. It rewards understanding. Most people never learn how this system truly works, not because the information is hidden, but because it's uncomfortable. It forces you to question assumptions, ignore noise, and think in decades instead of days. That's what we focus on here. At BackToBetter, we study money through history, behavior, and economic reality, so you can make calmer, clearer decisions over time. If this perspective helped you see the market differently, consider subscribing to BackToBetter